You know, if you ask 1,000 people what the single most important tool on their chart is, 999 of them will tell you it's the moving average. They'll talk about the 50-day, the 200-day, the 10-day, the 21-day. They treat these lines like ancient scripture, like they hold the key to the entire market's future. And they are wrong. They are fundamentally, devastatingly wrong about what that line is actually for. The moving average in the hands of the impatient trader is not a tool for profit. It is a meticulously designed psychological trap. It is the market's oldest, most effective mechanism for separating the emotional from their capital. Think about it. Why do people love the moving average? Because it promises simplicity. It promises action. It draws a line on the sand and says, when the price crosses this, you buy. When it crosses back, you sell. And that, my friends, is the siren song of immediate gratification. It feeds the fundamental human craving to be active, to be doing something. It validates the belief that success in trading is measured by the number of trades you execute. Let me tell you the brutal truth about that crossover. The market knows you are watching it. It knows that every amateur, every novice, every itchy-fingered trader is waiting for that simple flip of the line. And what does the market do? It manufactures noise. It creates false signals. You see the price approach the moving average. Your heart rate goes up a little. You are anticipating the trigger. The price nudges over the line, a beautiful textbook crossover. You jump in, excited that you caught the move. And then within 2 days, the price collapses back below the line, often moving just far enough to stop you out, taking your capital and leaving you bewildered. That, my friends, is the whipsaw. That is the market's tuition fee for impatience. The moving average, used as a trigger, is nothing more than a license to be systematically destroyed by noise. The market is not a smooth, predictable machine that respects your simple lines. The market is chaotic, and in that chaos, it generates just enough random movement to fool the majority who are looking for a simple, immediate signal. Do you see what I'm saying? The psychological trap is the belief that every wiggle, every crossover, every touch of that line demands action. It demands a click of the mouse. It validates your need to be involved. And that need to be involved is the single greatest enemy of your portfolio. You must stop treating the moving average like a starting gun. That line is not a signal to enter. It is a confirmation of a trend that is already underway. If you are waiting for the crossover to tell you what to do, you are already too late, or you are about to be fooled. You are trading the noise, not the trend. Now, let's talk about the few people who actually make money with this tool. The people who understand the game. You have to look back at the great operators, the ones who truly understood momentum. They didn't invent the moving average, but they understood the principle behind it. Momentum, once established, tends to persist. And here is where the counterintuitive solution comes in, the one that demands a level of discipline that 99% of traders simply do not possess. This is the lesson that Jesse Livermore taught. Though he didn't have computers drawing 50-day lines for him, he understood the principle of confirmation. Livermore's solution demands that the moving average is used not as a trigger, but as a confirmation tool. What does confirmation mean in this context? It means you have already done the hard work. You have analyzed the fundamental conditions. You have observed the price action. You have identified a potential primary momentum shift. A big move, not a little squiggle. You are sitting there, maybe for days, maybe for weeks, watching the price consolidate, watching the volume dry up, watching the underlying structure shift. You have a theory, you have a plan. And the moving average, it is the witness. It is the jury that confirms your suspicion. You wait until that price doesn't just cross the line, but until it establishes itself firmly above or below that long-term average. It has to be unmistakable. It has to be violent. It has to be a move that screams, I am here and I am going. This forces the trader to sit idle for weeks, sometimes months, until the trend alignment is so obvious that it is almost painful to look at. Doesn't that sound strange? That the key to using this signal successfully is to ignore it most of the time? Most traders look at a chart and see a potential trade every hour. The professional looks at the same chart and sees a potential trade maybe once a month or maybe once every 3 months. That is the difference. The professional is waiting for the alignment to be so perfect, so synchronized, that the moving average is simply confirming the obvious. You must force yourself to wait until the price action, the underlying fundamentals, and the momentum average are all singing the same song at maximum volume. If you are looking at a 50-day moving average and the price is hugging it, crossing and recrossing every few days, that is not a signal. That is noise. That is consolidation. That is the market telling you, I am not ready yet. Go home. The amateur tries to trade the consolidation. They try to scalp the wiggles. They try to guess which way the market will break, and they lose. They lose their patience and they lose their capital. The professional waits. They wait for the moving average to flatten out, and then they wait for the price to explode away from it, demonstrating clear, undeniable momentum. The moving average then becomes the baseline, the anchor, confirming that the new primary trend has locked into place. If you use the moving average as a trigger, you are trading noise. If you use the moving average as confirmation, you are trading momentum, and momentum pays. This brings us to the brutal reality of the strategy itself. Because if you are going to trade infrequently, if you are going to wait weeks or months for that perfect alignment, you cannot treat it like a casual trade. The brutal reality is that this strategy only works when you trade infrequently. Committing capital heavily only after the moving average confirms the primary momentum shift. Think about the math. If you take 20 small emotional trades a month, you are going to incur 20 sets of commissions, 20 chances for mental error, and 20 opportunities for small, frustrating losses. These small losses, these paper cuts, bleed an account dry faster than anything else. But if you wait for the setup that is confirmed by the long-term moving average, the setup that screams undeniable trend, you might only execute 4 trades a year. But those 4 trades must be large. Why? Because you have minimized the destructive power of small emotional losses. You have saved your energy, your mental capital, and your actual capital for the moments when the odds are overwhelmingly in your favor. When that moving average finally confirms the massive shift, when the market has been silent for 3 months and then suddenly screams into life, that is when you commit. That is when you put on the size that makes the waiting worthwhile. Does that sound risky? To commit heavily? Only if you haven't done the waiting. Only if you haven't done the analysis. If you are using the moving average as confirmation, you are trading with the primary force of the market behind you. You are not fighting the current. You are riding the tidal wave. And you do not ride a tidal wave with a tiny surfboard. You need the commitment that matches the conviction. The small trader, the impatient trader, they cannot do this. They are afraid to commit heavily because they are constantly taking small emotional losses, which destroys their confidence. They fear the risk because they have no foundation of discipline. But the disciplined trader understands that risk is relative. The risk of losing 5% on a trade where the odds are 50-50 is high. The risk of losing 5% on a trade where the odds, through meticulous waiting and confirmation, are 80-20 in your favor is acceptable. You shift the odds by waiting. You amplify the reward by committing. The moving average, therefore, becomes a psychological filter. It filters out the noise, and more importantly, it filters out the impatient trader. It forces you to wait for the market to prove its intentions before you risk your money. Now, let's talk about the hardest part of the entire strategy, the part that separates the millionaires from the merely hopeful. The actual strategy is simple. Define the trend, secure your position, and then exercise the ultimate discipline, doing nothing. That is the true work of the moving average strategy. It's not about the entry, it's about the hold. You have waited weeks. You have seen the price explode away from the 200-day average. You have secured your position. You are in. You have committed the capital. Now what? Now you wait again. The market will test you. It will immediately begin to generate noise designed to shake you out. It will pull back 10% against your position. It will cross below the 10-day average. The news headlines will scream that the move is over. Your friends will tell you that you should have taken profits. And you, the disciplined operator, must sit there and do nothing. Why? Because you are trading the primary trend confirmed by the long-term moving average. You are not trading the short-term noise. If you have waited for weeks for the 200-day average to confirm a major momentum shift, you cannot panic because the 20-day average gets breached. That is like an ocean liner changing course because a speedboat crossed its path. It is irrelevant noise. Your initial analysis, your conviction, was based on the long-term momentum. Your exit must also be based on the long-term momentum. The discipline of doing nothing means you must ignore everything that does not violate the underlying structural integrity of your trade. What violates that integrity? Only one thing: the market violently proving that the long-term move is definitively over. That means you hold the position until the market itself forces you out. You hold it until the price doesn't just cross the 200-day average, but until it collapses through it with volume, staying below it, and showing every sign of reversing the primary momentum. Until that violent, undeniable reversal occurs, your job is to sit on your hands. This is where most traders fail, even after they have mastered the entry. They get nervous, they see a 20% profit, and they are afraid it will disappear. They take the small profit, only to watch the stock run another 80% without them. They traded the noise of their own fear, not the signal of the market's trend. Do you understand the implication? The moving average strategy that actually works is a strategy of profound inertia. It requires you to be inactive 95% of the time. First, you are inactive while waiting for the confirmation. Second, you are inactive while holding the position, ignoring the noise. It is a strategy built entirely on patience, not on activity. The moving average is your anchor. Once the price is far above it, that average becomes your psychological shield. Every time you feel the urge to sell, every time you feel the urge to take a small profit, you look back at that confirmation line. Has the market violated the long-term structure? Has the primary momentum truly reversed? If the answer is no, then you have no reason to act. This is why trading is so difficult for the active mind. The market rewards stillness. It rewards patience. It rewards the ability to withstand temporary discomfort for the sake of massive long-term gains. Let me tell you, there is no greater feeling in trading than watching a major trend unfold, knowing you are heavily committed and having the discipline to simply watch the paper profits pile up without interfering. That is the definition of letting your winners run. But you can only let them run if you have defined your exit based on the structural integrity of the trend, confirmed by your long-term moving average, and not by the flickering light of your own fear. If you are constantly fiddling with your trades, if you are moving your stops based on every headline, if you are taking profits because they feel good, you are not a disciplined trader. You are a worried gambler. The market has a way of rewarding conviction and punishing anxiety, and the moving average, used correctly, is the physical representation of that conviction. It says, I believe this trend is intact until this long-term line is violently broken. If you can adopt this approach, if you can wait weeks for the entry, commit heavily when the confirmation hits, and then sit idle for months until the primary trend is definitively over, you will find that your trading life changes completely. You will stop focusing on the daily noise. You will stop caring about the 1% wiggles. You will start focusing only on the big, undeniable moves that pay for the houses and the retirement. You will realize that the most powerful insight a chart can give you is not the exact moment to buy, but the exact moment to recognize that the big money is finally moving. And that moment is almost always confirmed by the long-term averages. But remember, if you use it as a trigger, it is a trap. If you use it as a confirmation, it is a key. The choice is yours. Will you be the impatient trader who is whipsawed by the noise, or the disciplined operator who rides the primary trend? The moving average is simply a line on the chart. Its power or its danger lies entirely in the mind of the man who interprets it. If your mind is disciplined, the line is your friend. If your mind is greedy and impatient, that line is your executioner. Now, if this sounds like a familiar voice, if this advice about waiting and discipline and riding the big move resonates with the deepest, most profitable part of trading, then you already know where these lessons come from. This entire framework, the necessity of waiting, the focus on the primary momentum, the brutal cost of impatience, the ability to sit still while the market tests your resolve, it all traces back to one foundational truth. It traces back to the greatest teacher of speculation who ever lived. The ability to use the moving average correctly is nothing more than the ability to practice patience. It is the ability to wait for the conditions to line up and then to hold your ground against overwhelming psychological pressure. You need a mentor who paid the tuition for you, someone who learned the hard way that the big money is not made in the action but in the sitting. You need the story of the man who learned how to wait for the confirmation, how to commit to the big move, and how to ignore the noise. You need to read the book that details the journey of learning this exact discipline, the monumental effort required to transition from a small-time gambler chasing every tick to a major operator waiting only for the undeniable confirmed trend. I am talking, of course, about Reminiscences of a Stock Operator. It is not a textbook on charts. It is a textbook on the human mind and the market. It teaches you why the moving average, when used impulsively, will ruin you, and how, when used with patience as a confirmation of the trend, it can make you. It is the essential guide to understanding that waiting is not a passive activity. Waiting is the most active form of discipline a trader can possess. You must internalize that waiting, or you will forever be paying tuition to the market's noise. I've left the path to this book below. It is there for the taking. Do not ignore it. School is out. The market opens tomorrow. Be ready.